We're back to the original theme when we started this conversation, was describing investor psychology, right? Behavioral, the behavioral component of all this. And you were talking about Tina, but really the major driving force of what you described is recency bias. I mean, we have short memories. We really have short memories. I mean, it takes, there's very few money managers that are still active today that have seen stocks and bonds lose money together. And so I think people are still to some degree shocked. They're still believing that they can buy the dip to some degree. And the shoe has yet to drop for a lot of these people that, I mean, partly is they're still hoping that, inflation is going to come down. They're going to be back to Tina dynamics.
Well, look at the summer rally, to your point, Richard. It was a reflexive bounce of BTFD by the freaking dip, right? And the regime is different.
But it's interesting because let's talk about the economy, because in the U.S. economy seems to continue to be strong. Right?
No, I disagree wholeheartedly disagree.
Hold on a second, but the what you're seeing in earnings is not reflective of what you're feeling here, Mike. Right? Yet.
No,
right?
60%. So I disagree. We have global growth imploding across the world. You have 60% of the yield curve inverted. That was 70% a month ago. So you take
U.S. the economy here, right?
I'm talking about the U.S. yield curve. I'm talking about the U.S. The only the only holdouts in the U.S. economy, if you look at a broad swath of economic indicators that are leading indicators for recession. So we have a problem in that everyone tries to nowcast everything, and the nowcasts are just starting to turn over, but they're nowcasting. If we look at the leading indicators, they are all saying, 11 out of 15 of them are saying, hey, it's a recession. You need 4 to safely make a recession call. So we have 11 of them that are not saying the economy is strong. The labor is one holdout for sure, which, by the way, is largely lagging. And if you dig a little bit deeper and you look at states that are more early indicators for unemployment claims, you'll see they're already turning up. So
this is kind of what I wanted to get to.
Which states are early? So I hadn't really thought about that. So some states are going to give me a better guidance. Which ones do you know offhand? Which ones?
I don't know. I can look them up, but they are the more marginal states where there's more of a transient and sensitivity. They're not like, the New York or the main manufacturing hubs. Like those things are a little bit more, they hold in. It's sort of like those if I can make the corollary in the index sense, right? The generals get sold last and they support a lot of times that index. And same thing in employment, that there's these very large states that really kind of hold in the most. And what you want to look at is a little bit more of the early warning states to give you a sense of where you may be heading on a grander scale.
Industrial base.
Right.
Something like that. So you get industrials being because highly cyclical. And then some Midwestern state with big industrial base might be the first to go, whereas a more service based, something like okay.
Yeah.
Now I'm going to steal that concept from you, and I'm going to make
we'll follow up. I'll follow up the information on that. I'll send you the sort of the.
This is kind of exactly what I wanted to get at, Mike. This is what I wanted to get at, right? So I'm with you on all the forward-looking indicators. The problem is that what you hear when people talk when the talking heads on CNBC and whatever, they're asking them about the economy now, right? And now casting is that we're still good. You're looking at earning expectations to be on trend over the next 12 months versus the last 3 years. They're expecting the same trend of earnings growth, right? The analysts in the street, and so the now casting group is saying, hey, we're still strong. This is a weird recession. If it is a recession, I don't care whether the yield's inverted, right? And so let's assume for a second, what?
Well, again,
I'm not saying I don't care. I'm saying they're not caring. Right?
No, I agree. This is there's
a big disconnect between financial markets and the economy.
I think we want to put more of an emphasis on the leading indicators because that's where we're going. I think the error is trying to do nowcasting going to tell you, okay, now we're in a recession. Well, what use is that when markets are off 30%?
It's not.
And you're like, I'm in recession. Like that's like an NBER recession. That's revisionist history.
But what's shocking to me is it's not. And what's shocking to me, and Jeff, you pointed this out in the beginning of the call, is that rate hikes have been the biggest driver of the drawdown in equities, right? Mm-hmm. Rates are being priced in, right? The QT to be priced in, right? Even though, in spite of the fact that we'll be executing on it this month, the Fed will, it's priced in. What doesn't seem to be priced in is the hit to earnings, the future hit to earnings. The expectations there, it's not priced into the market at all, right? So market timing is all about what's priced in and what isn't. I feel like rates are priced in. I feel like quantitative tightening is priced in, but the economic hit to earnings does not seem to be priced in yet. And that's kind of where I'm saying.
I guess we would differ in that opinion, in that I don't really think.
I want to hear Jeff's expertise on the earnings.
That's fair enough, but the full impact of rates, I don't think has been priced in either. That would be my sense. The only thing that you can look at across a broad swath of economic indicators that are forward-looking that is at all positive is labor. And maybe there was a marginal turn up in ECRI's weekly forward-looking indicator, which is there's a possibility that it's a shallow recession. It's possible. I mean, there's a lot of work to do to make that happen, though.